Okay, so for part two of this chapter, we're going to jump into some calculations. We want to talk specifically about business taxes, and then we want to talk about calculating the cash flows of a company. So again, obviously, people have to pay taxes. The income of sole proprietors and partnerships is always taxed at the individual owner's level, whereas corporate income is taxed to the corporate taxes. But let's not also forget, as we spoke about a little bit earlier, that in addition to paying corporate taxes, the owners also have to pay taxes on any dividend income. Now, typically, the types of taxes we're talking about are ordinary income and capital gains. So we'll talk about how those things are utilized, but primarily we're going to focus on the actual calculation of taxes. So there's a couple of different tables, and it really doesn't matter which table you use. I prefer this one in the blue. It just, to me, it's a little bit easier to do the calculations with. But this is the corporate tax code for obviously for businesses. And the way I like to think of this is every dollar that you earn is taxed at a certain percentage. So the first $50,000 you earn is taxed at 15%. But when you make $50,001, that next $1 is taxed at a higher rate. Now, the first 50,000 is taxed at 15, so that's 7,500. So this number in this column represents the taxes paid on every previous dollar. So if you make $60,000 in income, you're going to pay 7,500 plus 25% of whatever amount is over 50,000. So 25% of 10,000 is $2,500. So the tax on $60,000 would be $10,000. So let's look at an example here. Here's the company. They have before tax earnings of $250,000. So how do we calculate that tax? Well, let's go back up here to the table. 250,000 is in this row. So it's 22,250. Now that represents all the tax from the first three rows plus 39% of the excess over 100,000. So that's our calculation right here. So the total tax paid would be $80,750. It's a pretty easy calculation. That blue table makes it pretty easy to follow. But let's investigate a little bit further. There are actually two tax rates that we can calculate or talk about. The first one is called the marginal tax rate, and that represents the rate at which additional income is taxed. So if we go back up to this example, $250,000 is in this row. So if you made $250,001, that next dollar is taxed at this 39% rate. That's this column here represents marginal tax rate. So to find the marginal tax rate, you find out where the dollar is, where the amount is, and then just find out this column. In this case, it's 39%. Now, the average tax rate is the amount of tax, $80,750, divided by the taxable income, $250. So the actual average tax rate is 32.3%. Now, my question before we move on is, which one of these is most important? And the answer is the marginal tax rate is the tax rate that you want to use for making financial decisions. If you can see, we would make a pretty big mistake if we use the average. We'd be 6.7% off in our tax calculation for any project that makes more than 200 adds on to this $250,000. So again, marginal tax rate is the most important tax rate that we have. Next, we want to talk about dividends. For corporations, and this is for corporations only, 70% of all dividend income received in the stock for another corporation, in which the company owns less than 20%, is excluded from taxation. So again, if you don't own more than 20% of a company and you receive dividends, you only pay taxes on 30% of the dividend income. What this does is essentially offset some of the impact of double taxation. Now, the difference we have, though, is unlike dividend income, all interest income is received is fully taxed. So the tax burden on interest income is huge, especially for a big corporation. So most large corporations will not invest in the securities of bonds in other corporations. So if we're calculating taxes, again, we have to subtract operating expenses and interest expenses, but dividends are not deducted. They're not tax deductible. So what this does is it creates what's referred to as a tax advantage. Sometimes it's actually even called a tax shield. So here we have two companies, the debt company and the no debt company. The earnings before interest and taxes is the same, but that company borrows. So they have interest expense of $30,000. Look at the difference in taxes paid. The debt company pays far less in taxes than what the no debt company does. So the tax shield of interest is reducing the amount of taxes necessary that are due because of this tax burden. But let's think about it. What's the difference? 80,000 minus 68,000 is $12,000, right? 12,000, 80,000, right? But we have interest of 30. So we spent 30,000 in interest, and we reduced it by 12,000. So we still had to. There's still some impact of interest, but we actually have a $12,000 tax savings because of the deductibility of interest. Again, we can show how this, obviously, it might change earnings per share, because if we borrowed, we probably have fewer shares that we have to divide our income by. So the taxability of interest and other expenses reduces the actual after-tax cost. The government is essentially subsidizing the expenses when you can deduct them from income. Capital gain is another kind of tax when a company sells the assets that it uses to produce products. So it's selling the operating assets of the company. For corporations, capital gains are added to ordinary income, and they're taxed like ordinary income at the firm's marginal tax rate. So here we have this Ross company. Ross company, I thought I had the calculation, just sold for $150,000 an asset that was purchased 2 years ago for $125,000. So they've made $25,000 in profit because it was sold obviously for more than its initial purchase price. There's a $25,000 capital gain. But again, that is added to the ordinary income, and then they pay taxes at the marginal tax rate. So let's do a quick little example. How do you calculate the tax? Or if you earned $4 million in taxable income, how would you answer these questions? What is the firm's tax liability? What is its average tax rate? And what is its marginal tax rate? Well, we could do this with a spreadsheet if we'd set this up. And I just left this in here because what I would suggest you do is to use the formula to do this calculation just to double check and make sure the numbers are right. So in this case, the actual tax liability is $1.36 million. The marginal tax rate's 34% because we're still in this row, right? So 34% is the marginal tax. And the average, if you divide 1360 by 4 million, they're equal. What we find is as companies make more and more income, the marginal tax rate and the average tax rate converge with each other. So in the end, they're going to be very, very close together. So it allows us to say things like the average tax of a large corporation is roughly 40%. That means it's in this neighborhood, 35% if they have taxable income over 18 million. That's their marginal rate. Add state taxes to that. So most companies are going to pay in the ballpark of around 40%. By the way, 40% is a little bit easier to multiply by. The next concept to talk about then is cash flow. And it's one of the most important pieces of information we can get. Unfortunately, the statement of cash flows doesn't quite give us all the information we need. What we want to focus on is how much cash is created from using the assets of the company, and then in the end, how is that cash paid out to the investors of the company? So I found throughout my studies with this particular topic is that some textbooks use slightly different terminology, if you will. So I'm going to use a little bit of it both here so that we can kind of understand. I think some of the terminology is a little bit easier to follow. But we essentially want to calculate what's referred to as the cash flow from assets. That's CFFA, or what's typically referred to in the finance literature, something called free cash flow. And to find that, we have to calculate three things. We have to calculate the operating cash flow of the company. We need to subtract from that the net capital spending, or the changes in net fixed assets, and we have to subtract the changes in short-term investments. We have to look at changes in net working capital. That number, the cash flow from assets, then, is distributed to the investors. Well, who are the investors? We have the cash flow to creditors, and we have the cash flow to stockholders. So whatever this number is, whatever the free cash flow number is, it ultimately is distributed, or can be distributed, to one of these two sets of investors. So let's look at operating cash flow first. Again, this is the cash flow that's generated from normal operations. So an easier formula down at the bottom, EBIT times 1 minus T, that's the earnings before interest and taxes, times 1 minus the tax rate, plus depreciation. So this is our cash flow from running the company. So we have the company that we've been looking at in this chapter called U.S. Corporation. And if you go back and find those financial statements, you'll see that to calculate operating cash flow, EBIT is $694. The taxes that are paid is $212, and you add back depreciation. So the operating cash flow of U.S. Corporation is $547. So we can at least conclude at this point that U.S. Corporation's operations are generating positive operating cash flows. Now, of course, we'd want to compare this historically to what the company has been doing to make sure that they're maintaining progress and consistency in creating cash from operations. The next two we can look at, and we can divide these or talk about them differently. The first is the change in fixed assets. This is the fixed assets at the end of the period minus the fixed assets at the beginning plus depreciation. So this is NCS in your textbook. Some other textbooks would have this as being NFAI, net fixed asset investment. But this just shows the change in fixed assets adding to that depreciation. So for the U.S. Corporation, that's 130. The change in net working capital, STI, is short-term investment. Again, some textbooks look at this slightly differently, and we'll talk about that here with the red note below here. But essentially, we want to find the change in net working capital. So you take the change in current assets from beginning to end, and you subtract from that the change in current liabilities. There's a typo right here. That should be actually current liabilities. I'll change that in the future. That gives us, in this case, it's $257 is the total investment in short-term working capital. So the company made, if we go back here, they brought in $547 from operations. They spent $130 net on fixed assets and $257 net on short-term assets. Now, in some textbooks, and quite frankly, I believe this is the way it should be, notes payable are not included in this calculation. And the reason they're not calculated is because notes payable include an interest payment. And free cash flow, or the cash flow to the cash flow from assets, is to be distributed to creditors who earn interest. So this textbook uses notes payable in this. If there are short-term notes payable, they use them in this short-term capital calculation. So when we pull these things together, free cash flow is the amount of cash flow that's available to the investors. And the investors are both creditors and owners. So after the firm's met all of its operating needs, paid for all of its investment and net fixed assets, and the net current assets, that's what's left over to pay towards creditors. Again, the creditors, just to remind us, are both creditors and owners. This is a very important number for investors in capital. They want to have some feeling of how certain the cash flow payments would be on their investments. So again, for U.S. Capital Corporation, we get a total or a net of $160 is increased in cash that again is available for investors. What would come from that? We could pay off debt. We could pay interest. We could pay dividends. We could buy back stock. So all of those things are possible with this particular number. Now, there is a spreadsheet that's available that you could download that has something called the free cash flow calculation. And what you do with this spreadsheet is you enter the numbers in the yellow boxes. And there's an actual video, right? That's a part of the Moodle experience here. There's a video. You can watch this video that discusses how this information is input in there. Now, that video assumes that notes payable is not included. I haven't redone that particular thing, but it excludes notes payable if notes payable are a short-term item. But in the end, as long as you always do this the same way, there's no real difference as long as you're consistent with your approach to notes payable. So in this case, again, you see there's $160 left over. Well, how is that money distributed? $58 goes to creditors and $102 goes to shareholders. So that's how ultimately the money, this free cash flow, can ultimately be distributed or has been distributed to those investors. That's the end of chapter 2. If you watch, there are 2 videos that are available to work with these problems. There's a video on tax calculation. There's also a video on the free cash flow calculation. I'll see you in chapter 3.